is Wednesday, August 3rd, 2022. I'm John Kosar from Asbury Research, and this is your Daily 5. These are my 5 most important charts, data series, and signals from our own quantitative models that I believe are the most important to pay attention to and are going to have the most influence on the direction of the U.S. stock market over the next several months. Let's begin. Number 1, market internals. The Asbury 6 has turned positive. The last time that I was with you, which was June the 29th, we pointed out the Asbury 6 was negative. You can see it was on a negative signal here since June the 10th. It fluttered around in here near the lows, which we call blinking, which sometimes helps to identify an inflection point or a directional turning point for the market, and actually flipped to positive here on July the 19th. I think the S&P is up 5% since then, and you can see all 6 of the Asbury 6 are green or positive. Those numbers that are in the cells are the dates that each of the 6 constituent metrics within the Asbury 6 turn positive. And you can see there's kind of a cluster in here between the 19th and the 20th. Here's the 19th again. 4 or more green or positive metrics indicates a directional signal. So it would take 4 or more red to turn the Asbury 6 back to negative. So it's been on a positive reading for a couple of weeks or so now. The way the Asbury 6 works, a step back from there, the reason we built the Asbury 6 is because the market doesn't trade the way it used to trade 10 years ago, certainly, and even 5 years ago. There's a lot more day-to-day volatility where the market's up 50 or 60 today, it's down 50 or 60 the next day, and then it's down 30 overnight and up 50 the next day. Just watching what the S&P 500 does every day can really force you into making a lot of mistakes. And it's not a clear indication of what the condition of the market anymore. So we back-tested my favorite tactical indicators over my career, and we paired them up in different groups. And we found that these 6 work very well to offset each other because there's no indicator that is always going to give you a clean signal, always going to give you a good, reliable signal. They all have their Achilles heel. So these 6 are pretty diverse. We've got the relative performance of stocks versus high-yield bonds, investor asset flows, corporate bond spreads, trading volume, market breadth, and the only one that has to do with the S&P 500 is the rate of change in the S&P 500. So what we tried to do is take the focus off chasing the S&P 500's tail every day and kind of look under the hood of the market, so to speak, and see what the internal health is. So right now, the internal health of the market is good. It indicates that on a tactical basis, the market is amidst favorable health conditions, let's call them, to keep going higher over the near term. Number 2, the S&P 500. Support and resistance equals risk versus reward. And what I mean by that is we all know that over time the S&P 500 goes higher. When I came from the commodity space, I was on the trading floor of the Chicago Mercantile Exchange for 17 years in the 1980s and 1990s. And most of those markets, foreign currencies, bonds, a lot of the commodity markets, over time, they can just as easily move up or down. Stock market's different. The stock market has an inherent upward bias. So the difficulty in making money in the stock market, at least to me, is not getting the direction right, but knowing where to put the position on and where to take the position off. So you're dancing in between the raindrops. You're catching that 70% of those larger up moves, and you're avoiding most of the down moves. I think that's as good as you can do there. It uses the inherent upward bias of the market in your favor. So let's look where we are right now. The last one of these that I did back on June the 29th, I had mentioned that we were testing support, and there were some longer term metrics, strategic metrics we call them, that suggested that if we weren't at a bottom, we were close to one, and we may see one over the next month or so. The reason it held down here, or at least one of those reasons, is it was testing support. You could see it from the Jan and March 2021 lows. This is the S&P 500 going back a couple of years, going back to the beginning of 2021 with its 250-day moving averages. Its 200-day is orange on our charts, and the 50-day is blue. So kind of tested this area for almost a month, 36.94 to 36.46. And then we had a rally off those lows, and we finally broke the 50-day moving average at 45.92 here in the early to mid part of July. That was just a couple of days from when the Asbury 6 turned back to positive. So now that we had broken resistance up here, that kind of opened the doors for the market to go higher. And the next level that we saw on the chart is right here at 41.15 to 41.78. So we basically bought the market here, and we're long, and now we're up against resistance again. So that tells me the market has another decision to make. So I need to keep a close eye on the Asbury 6 to make sure that the 6 constituent metrics stay in a positive category. So what we're waiting for here is if we get a breakout through this 41.15 to 41.78 area that we've been up against now for about a week, that's going to clear the way for the next move. And we think that next move is likely to be up to this 42.79 to 43.41 area. I'm circling it with my mouse. That's the kind of the convergence of the October 4th benchmark low here at 42.79 and the 200-day moving average, which is at 43.41, but it's moving down a little bit every day. So again, we went back to risk on here right around 4,600, and we're waiting for a breakout of this 41.15 to 41.78 area to open the doors, clear the path for a move to test this major resistance. If we break the major resistance, that's going to turn the major trend up, and that's going to, I don't want to get too far ahead of myself here, but should that happen, that would clear the way for more strength and a test of the March 29th and the January 4th highs. So that's where we are when you're looking at this as kind of a board game. And where should I add risk and where should I subtract risk? The flip side of this is if our Asbury 6 goes back to risk off and we hold this resistance, that's going to tell us that we need to reduce exposure because we're heading back down again. So I did a lot of forecasting early in my career. That's how you got quoted in the Wall Street Journal. That's how you got on television. Right now, I do a lot more following the data. I'm not going to try to pick a major bottom and say that it's going to last for the next year because I don't need to do that. All I need to do is follow the data and follow our metrics. And as the market changes, as the economy changes, and people's perception of what the health of the market changes, we change with it because all we're doing is following the money. Number 3, the SEAF models, Overweight technology since July the 11th. The last time I was on with you, I talked about the need for leadership in the market back at the end of June. There was no leadership at that time. Small cap technology and semiconductors were all underperforming the S&P 500. I said that had to change in order for the market to become healthy again and to start a rally. Well, our SEAF model turned to positive on the early part of July. Actually, since 7/11, it turned back to positive on 7/11. Since then, it's risen. The XLK, which is the Spider Tech ETF, technology ETF, XLK. It has risen outright by 11% and has outperformed the S&P by 3%. This is the leadership that we were looking for. You need leadership in order to get the market to shift gears and go back to a bullish mode. And we have that now. So right now we have existing trends of inflows into healthcare, according to our SEAF model, and technology. Healthcare since 310, March 10, technology since 7/7. So the next trading day was 7-11. That's why the discrepancy between 7.7 and 7.11. And finally, the latest data also indicated an existing trend of outflows from financials and consumer discretionary. Financials has been since 3.3, so we've been avoiding financials like the plague. Why? Money is going out of them. Why is money going out of them? Choose an answer for that. There are certainly many that you can choose from, but all we're interested in is if the money is going out of a certain space, we don't want to be there. We want to go where the money is going, and you can see that on our SEAF model. More technology, providing the necessary leadership. So we talked about the money starting to shift over that into tech according to our SEAF model. SEAF, by the way, stands for Sector ETF Asset Flows. So we saw the money moving there, and right about that same time, or a little bit afterwards, you start to see it in the chart. This is a updated version of one of the charts that I showed on June the 29th. It shows the NASDAQ composite index here going back to January, and we were looking at it holding the support in here. Here's June 29th, kind of when I was on right in here. I mentioned that it was a big support level, and we had the 50-day moving average as kind of a overhead resistance level was squeezing in from the top. So it comp actually broke out of the 50-day moving average on July the 19th here. You could see it went back to retest it as support, and it's moving higher. That support on the 50-day is 11,570. But earlier than that, look at this relative performance. Right around the time the SEAF model showed there was money going back into technology, the relative performance line between comp and SPY, which is the ETF that tracks the S&P 500, of course, it moved back above its 63-day moving average to show us a strategic trend of relative outperformance. It had been underperforming the S&P, as you can see here, for a long time. This underperformance trend actually extended into the latter part of 2021. So now we have outperformance, we have outright performance, we have the leadership that we need for this rally to have some legs. Finally, the last time I was on again, I think we looked at the investors' intelligence data, and I had pointed out that this wasn't a timing tool, but investor sentiment was at a bearish extreme that, going back over 10 or 20 years of history, coincided with some pretty important bottoms. The last one was the COVID lows in March of 2020. Then there was one at the latter part of 2018 and on back from there. Here's another one to look at. And again, these aren't timing tools. These are environmental tools that tell us when the Asbury 6 turns to positive, should we be expecting a little rally, or should we be maybe expecting a bigger rally? This is another indication that this could be a bigger rally. Let's have a look at it. We have the percentage of NYSE composite stocks that are trading above their 200-day moving average down here. It goes all the way back to 2002. And here's the S&P 500 here, up top, going all the way back to that same date of 2022. So when this metric gets below 18, it's been pretty indicative of some kind of an important strategic bottom. For us, strategic is one or more quarters. So you can see as of the 1st of July, just about a month ago, we went down a little bit below 18 in the indicator and popped back up. The last 6 times that we did this were March of 2020. Again, that was COVID low. Dec of 2018 right here. January of 2016. Here's August of 2011. Here's November of 2008 and October of 2002. So, does this mean the market has to bottom here? No, it could turn around and have another bottom somewhere in here, but it says in this neighborhood, unless there's something very extreme going on in the marketplace right now, which I don't think there is, this is a likely place to look for a bottom. Thus, when we look back at the Asbury 6, now we can put a little color to that and say maybe one of these risk-on situations that we have, like I said, the last risk-on that we had in the A6 was July the 19th, and the S&P is up about 5% since then. That lets me put a little color on that and suggest this could very well be a bottom that could take us into the fall, maybe even through the end of the year. So I know there's a lot of doom and gloom out there. There's, we're looking for a recession. We have midterms coming up. We have a war in Ukraine. We have inflation. There's all kinds of stuff going on there. But again, I try not to play multi-dimensional chess with the economy and the fundamentals. I just try to read the data, see where the money's going, and see what history tells me. And right now, it tells me that we are risk on a tactical basis, and that this could very well turn out to be a much more strategic bottom in the months ahead. So there you go. Thanks for watching. If you like our approach to investing, I invite you to go see our website, asburyresearch.com, or you could go to our YouTube channel and subscribe to our videos there. There's a lot more information like this on both the website and on the YouTube channel. Thanks a lot. We'll see you again at the next one.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.